In the last lecture, we looked at Keynesian economics and that really short-term focus that tends to dominate policy discussion and policy decision-making in most of the Western world. Now we're going to talk about neoclassical or Austrian-influenced economics and how that longer-term view tends to predominate over, again, the long run in economic thought, if not decision-making. This chapter is going to have three sections to it. The first one is building blocks of neoclassical analysis. The second is policy implications of neoclassical perspective. And then the third is balancing Keynesian and the neoclassical models. Because again, they seem to be in opposition and yet they can be reconciled when looking at it from a long-term, short-term, and intermediate lens. When we look at the impacts of the Great Recession of 2008 through 2011, we see that it really impacted a lot of our daily lives, whether that was as homeowners, as students, as working folks. One of the most visible signs of the 2008 financial crisis, the Great Recession, was in the housing market, where a lot of people were forced to abandon their homes and other buildings, including ones built midway through construction, because the values dropped so precipitously that the mortgages no longer covered the amount of the house. And some of those homes were bought on speculation, and as a result, they weren't able to be completed. They weren't intended to be occupied, and so when mortgages dried up and you were unable to get a mortgage for a buyer, sellers who built on speculation tended to walk away. From a neoclassical perspective, and again, neoclassical perspective is a philosophy that in the long run, business cycle fluctuates around potential or full employment level of output. And so as a result, we've got, we're really looking at the supply side of the economic curve, where in Keynesian thought, we were looking at how demand can shift up and down. On the neoclassical side, we're looking in the long run, supply changes. And there's two building blocks of neoclassical economics. First one is potential gross domestic product determines the economy's size. So when you look at that long run aggregate supply curve, that tends to determine the economy's size. And wages and prices are going to adjust in a flexible manner so that the economy will adjust back to the GDP level of output. So again, this is the biggest difference, where Keynesian economics says, look, prices and wages are sticky. They can't adjust effectively, and the government needs to step in to force that. Neoclassical economics says over the long run, wages and prices are flexible and they'll adjust, and we don't need the government to interfere. The importance of potential GDP in the long run is important, because over the long run, the level of potential GDP determines the size of the real GDP. So again, the long run aggregate supply curve, which is a potential GDP, is really driving that. Potential GDP is a level of output that an economy can achieve when all resources, land, labor, capital, entrepreneurial ability, financial capital, etc., are fully employed. And when unemployment rate and labor markets are at full employment, while that's never going to be zero, because you're going to have some of that kind of frictional unemployment that occur, full employment in the labor market refers to zero cyclical unemployment. So, anybody who wants a job can get a job. Anybody able to work can work. And to the extent that, folks are out of work, it's generally to be moving from one job to another, not because they can't find work. Economists benchmark actual or real GDP against potential GDP to determine how well the economy is performing. So how well is the economy doing versus what its potential is, and if it's above or below that, we know if the economy is overperforming or underperforming. GDP growth can be explained by increases in investment in physical and human capital per person, as well as advances in technology. So when we're looking at how do we grow GDP over the long run, it's really three types of investments. We invest in physical things, so physical capital. We invest in human capital, and we invest in technology, which is really the kind of the intersection of where physical things and humans intersect, and that technology amplifies the effectiveness of both. Physical capital per person is the amount and kind of machinery and equipment available to help a person produce goods or services. Increasing human capital involves increasing levels of knowledge, education, skill sets through vocational or higher education, and physical and human capital improvements with technological advances then increase overall productivity per person and thus GDP. So again, if you're looking at how do you build wealth in a society, it really is taking physical improvements, human capital improvements, combining it with technology and driving the level of effective overall productivity and output per person up. And again, you can see here in from 1960 to 2020, potential and actual GDP in 2012 dollars. So the potential GDP is on the solid line. The real GDP is on the dashed line. Actual GDP falls below potential GDP during and after recessions, like the recessions in 1980, 81 here, 1990, 91, which is a fairly mild recession here, 2001 here, and then the Great Recession you see here, and then this is the onset of COVID here. So you can see that also in a couple spots. So here after the recovery from the 2001 recession, we actually go a little bit above potential. We see ourselves a little bit above potential here in the mid 60s during Vietnam and around 1972 and a recession. We see ourselves a little bit above potential through once we came out of the recession of the early 1990s. We see ourselves a little bit above potential there as well. And then we kind of slightly kicked above potential in 19 before COVID hit. So potential GDP, how do we know what the potential is? Potential GDP is estimated by the Nonpartisan Congressional Budget Office, or CBO. Again, it's a governmental agency that hires a lot of academic types to do that type of analysis and provide congressional leaders, other government stakeholders, policymakers with information to be able to make data-driven decisions. Most economic recessions and upswings are times when the economy is 1 to 3% above or below potential GDP. So we tend not to see massive swings over or below potential GDP, and when we do, in situations like this, it tends to be, this is a significant recession. In a neoclassical model, we draw the aggregate supply curve as a vertical line with the at the level of potential GDP. So the long run aggregate supply curve, again, this is a vertical curve. If you remember, the Keynesian curve is basically an L-shaped supply curve. This is a straight line. If aggregate supply is vertical, then it determines the level of real output no matter where we draw the aggregate demand curve. So if demand is here or here or here, if it's here or here or here, it's going to change the price level, but the GDP isn't going to change. So over time, the long run aggregate supply curve is going to shift to the right as productivity increases and potential GDP expands. Again, there's a ratcheting effect on things like technology, human capital, where in theory it doesn't go backwards, it continues to go forward. So either rapidly or slowly, the long run aggregate supply curve should continue to shift to the right. Economists base the neoclassical view of how the macroeconomy adjusts on insights that if wages and prices are sticky, so kind of stepping back to that Keynesian view of wages and prices being sticky in a short run, they're still flexible over time. So if we focus significantly on the stickiness of wages, we're losing sight of this long run ability of the economy to adjust. So sticky doesn't mean fixed. And so as a result, there's over time, the wages and prices will adjust to reflect a new reality. The economy might produce above its level of potential GDP in a short run due to a surge in aggregate demand, might be driven by Keynesian methods, might be driven by pure market methods. However, the economy can't sustain that production above its potential GDP in the long run because you'll have unqualified workers. You're going to have machines operating beyond capacity. You're going to be beyond the kind of the technology curve, and things are going to recess back into an equilibrium. So in the long run, surge in aggregate demands ends up as an increase in the price level, not as a rise in output. essentially what ends up happening here is you've got an equilibrium point E0, which is, given the long run supply, short run supply, and aggregate demand at point 0. And then what the Neoclassical is going to argue is that, if we force demand out, so let's say we use some Keynesian stimulus, so increased government spending, tax cuts, to drive aggregate demand up, that drives us out to E1 on the short run aggregate supply, which then says, okay, we're producing above our long run aggregate supply target. So prices have risen, our output has risen, but we're in a situation where this isn't going to be able to be sustained because we're off the long run curve. So what ends up happening is machines start breaking down, there's labor shortages, so wages rise, etc. So now you've got the long run aggregate supply curve shifts, or the short run aggregate supply curve shifts up to now meet essentially the long run aggregate supply curve here at E2. And all that's happened is we didn't really increase on a sustainable basis a real GDP, we just raised prices. So as a result, the new equilibrium price point at E2 here is really just kind of showing inflation. So again, with unemployment rates low at E1, eager employers bid up wages. The increases in prices of a major input to production, like wages, shifts the short run aggregate supply curve to the left, and then new equilibrium price point shows. Thus, in the long run aggregate supply curve, which is identical to potential GDP, determines the level of real GDP. And you can, a supply sider or a neoclassical will argue, look, if you're operating here, kind of inside the price level or inside the long run aggregate supply curve below potential GDP, using some Keynesian, they argue, look, two things. One, over the long run, things are going to move in equilibrium. So just be patient. But if you can't be patient, your Keynesian stimulus can drive you up to the long run aggregate supply curve, and you'll be okay. As some of these adjustments occur. But if you push beyond that, you're then going to not only cause inflation, you're going to cause no increase in wealth. You're going to, you might see some temporary wealth transfer here, and labor might do well as an input, for instance. So wages might go up, or wages might go up, but they're going to fall again, and you're going to go through a recession, and you're going to end up back at the long run aggregate supply curve. The only way to fix long run aggregate supply, to cause that to increase out to here, is to invest in technology, people. And that's education, and not wages, but education and ability and fixed goods such as machinery to increase productivity. So you've got to increase productivity of an individual person to get this long run aggregate, or of people in general, to get the long run aggregate supply curve to shift. You can't just do it by raising wages. All that does is cause inflation. So the original equilibrium point here, if you are kind of going through that cycle, happens at the intersection of the supply and demand curve. This is kind of looking at a leftward shift in aggregate demand, and so as a result, if you see aggregate demand shift down, something occurs. So this is on the potential GDP line, long run aggregate supply line. We're in equilibrium. Then there is aggregate demand shifts to the left, so demand falls. And this may happen because of any one of a myriad of factors. You could use like COVID, for instance. So aggregate demand for gasoline falls because of a shift in the use of gasoline. The new equilibrium price point is at E1, with a lower aggregate level of output and downward pressure on the price level. So you've now not only decreased production, you've decreased prices. However, and so you've got a recession. However, what the Keynesian is going to say is you've got now higher unemployment rates, wage rates are held down. You've got people out of the workforce, so lower wages are an economy-wide decrease of a key input, which causes a short-run aggregate supply curve to shift from the left. So folks go, hey, I can hire more workers for less, so I'm going to go ahead and hire some workers. Might not be able to invest in technology at this point, or I might not be able to invest in additional fixed goods, but I can invest in more people. So, wages continue to fall, but productivity picks up, and the new equilibrium price point, real GDP, is back at the long run aggregate supply, but prices have fallen. So how fast does this happen? And again, this is where the politics of economics and the theory of economics tend to clash, because a lot of times these adjustments do take time. And when folks are out of work and they can't feed their family and they can't make their mortgage payments, there's a real hue and cry to do something now, and that do something is normally by the government, and now is not waiting for the market to adjust prices. Rational expectation is a theory that people form the most accurate possible expectations about the future they can, using all the information available to them, and that's how they make decisions. Someone will come up with a rational expectation for what's going to happen in the future, and then they make their decisions based upon that. In an economy where most people have rational expectations, economic adjustments can happen really quickly because everybody kind of sees what's going on. They go, okay, now I've got it. I see what's happening. Let me make my adjustments. I'll take that lower wage job because I know there's not going to be a higher one coming. I'm gonna make intelligent decisions about future investments. So I'm gonna not pay as much, or I'm gonna reduce prices as a producer to be able to get back to a kind of a better position economically. And it theorizes that everyone will recognize that the process is heading toward a change in the price level, and it acts on that expectation quickly without that zigzag of unemployment and output, and kind of seeing a bunch of over under until it comes back down to an equilibrium point. The alternate assumption is that people and firms act with adaptive expectations, and adaptive expectations is a theory that people look at past experience and they gradually adapt their beliefs and behavior as circumstances change. So they don't perfectly synthesize the information that's out there, or they rely on, I've seen this before and this is what's going to happen, even if it's not what's going to happen necessarily. And so they really are reacting more and adapting to the information coming in, rather than having a perfect picture of what they're doing and having a rational expectation of what's going to happen. If most people and businesses have a form of adaptive expectation, then the adjustment from the short run to the long run is going to be traced out in incremental steps that occur over time. You're going to see that zigzagging. You're going to see overcorrection, undercorrection. You're going to see a little bit more pain in the process as people go through the decision-making process, because their information is imperfect. So what are the policy implications of neoclassicalism? Well, there's the expected inflation rate. So expected inflation is a future rate of inflation that consumers and firms build into a current decision making. So if you listen to the news today, you'll hear that the target inflation rate is 2%. So to the extent that inflation is above 2%, we've exceeded the expected inflation rate, and so people are making decisions based upon that. To the extent that inflation is below 2%, people will make decisions based upon that. So the expected inflation rate in the current economy is around 2.5% for the United States. In the Keynesian perspective, the focus is on the government adjusting aggregate demand so that the economy produces at the potential GDP. So essentially, on the Keynesian side, we're going, okay, how do we force more demand into the system so the economy can produce more? Not so low that cyclical unemployment results, and not so high that inflation results. So we're trying to stay in that Goldilocks zone, not too hot, not too cold, but the government is adjusting demand using fiscal policy and again, in some cases, monetary policy, but normally fiscal policy to try and drive that. In the neoclassical perspective, aggregate supply determines the output at potential GDP. So the natural rate of unemployment determines unemployment, and shifts in aggregate demand are the primary determinant of changes in price level only, not in production. So all shifts in aggregate demand do, from a neoclassical perspective, all Keynesian forced shifts do is cause inflation in the long run. They don't really drive up any production. So let's look at the long run aggregate supply curve to a long run Phillips curve. So we talked about the Phillips curve before. where there's a trade-off between unemployment and inflation. So for graph A here, we have a vertical long-run aggregate supply curve. Shifts in aggregate demand, from 0 to 1 to 2, don't change the level of output, but do lead to increases in price. So demand goes up, but because supply is impacted by, essentially, the only way the supply curve shifts out is through longer run investments in technology, people, and production capability. All a shift in aggregate demand does is cause prices to rise. Because output is unchanged, the equilibria, E0, E1, E2, all unemployment in the economy is going to be at the natural rate of unemployment. It's not going to impact real unemployment at all because you're not seeing any real increase in production and gross domestic product. So as a result, you don't see any real change in the natural unemployment rate. For graph B over here, if the natural unemployment rate is 5%, then the Phillips curve is going to be vertical in a neoclassical sense. That is, regardless of the change in price level, regardless of the inflation, employment remains at 5%. So again, if you see a Phillips curve, the Phillips curve that we saw initially, that kind of held through the 60s and before, was a J-shaped curve where as unemployment rose, inflation fell. Then we saw in the kind of beginning in the late 70s through today, it looks more like there's no line of best fit, and if so, it's actually an upward sloping curve where higher inflation tended to also cause higher unemployment. And the Keynesian view is that doesn't make a lot of sense. And in the neoclassical view, all that doesn't matter because there's a natural rate of unemployment, and all those dots and movement around there are kind of recognition of short-run shifts in production, not long-run natural unemployment rate. So when the economy is producing a potential GDP, cyclical unemployment is at 0, and therefore, the goal is to be running at full employment or at potential GDP. For neoclassical economists, the view of unemployment tends to focus on how the government can adjust public policy to reduce the natural rate of unemployment. So long run, how do we put more people to work? Not short run, how do we adjust, based upon the factors today. So how do we change that natural rate of unemployment? How do we move, this long run aggregate supply curve out this way, which will then drive unemployment this way? Neoclassical economists don't tend to see aggregate demand as a useful tool for reducing unemployment because it just drives up inflation. Since a vertical aggregate supply curve determines economic output, the aggregate demand has no long-run effect on unemployment. So while we might be able to deal with something in the short run, the neoclassical economist says, look, in the long run, all you're doing is inflating prices. You're really not addressing the core issue. The core issue is we need to get more productivity out of the workers that we have through the use of technology, education, and additional tools. And neoclassical economists believe that aggregate demand should be allowed to expand only to match gradual shifts in aggregate supply to the right, keeping the price level much the same and inflationary pressure is low. So where Keynesians tend to focus on unemployment, neoclassical economists tend to focus on inflation as being kind of the boogeyman in the room that they need to manage. So as aggregate demand shifts from the right, from 80.0 to 81 to 82, there's inflationary pressure that go from 100, to 105 to 115. Long-run aggregate supply doesn't change, and the real rate of unemployment doesn't change. So if aggregate demand rises rapidly in a neoclassical model, in the long run, it only leads to inflation. It does not lead to new jobs. It does not lead to better living conditions for workers. It does not lead to growth in the economy. It doesn't lead to new technological development. It doesn't lead to anything other than inflation. That's the argument. So neoclassical economists believe that the economy will rebound out of recession, eventually contract during an expansion, naturally, because wages and prices are flexible over time and it'll adjust upwards or downwards to restore the economy to its potential GDP. The neoclassical economist is going to say, look, that the Keynesian view of let's adjust this, let's adjust that to try and drive these things closer or further away from GDP is unnecessary. The prices, while they might be sticky and it takes a little bit of time, there's going to be some more pain in the system. It's actually going to be a much more effective model, and it's not going to cause as much inflation. The key policy questions for neoclassicals is how to promote the growth of potential GDP, how to make the economy larger, how to get more productivity out of each worker. Economic growth depends on the growth of long-term productivity, not on short-term changes in unemployment rate. So a neoclassical economist says government policy should focus on promoting long-run productivity growth through investments in human capital, so education, training, and a vibrant, growing population, physical capital like equipment and other machines to make things more effective and efficient, buildings, etc., to make production more effective and efficient, and technology, so how those tools and people interact to become more effective and efficient. Operating together in a market-oriented environment rewards that innovation, and the government should be making sure that the markets are kept open, free, and fair, with free being more important than fair, and that those innovations are rewarded through the ability to be able to get profit. So there's a profits interest. So tracking employment and inflation rate. The graph here shows inflation and unemployment rates recorded every 5 years from 1970 to 2000. So you can see it's kind of a little bit of a scatter plot here. What patterns do you see in the data? Do you see the Phillips curve in the data? Again, here's the inflation rate, here's the unemployment rate. There is, kind of a little bit as we get into from 70 to 2000 over 5-year periods. So now we're not at the 1 year period that we saw in the last, kind of in the last set of graphs. But now in 5-year periods, you can see that, again, there's kind of a J curve, a downward sloping curve here, that shows inflation rate and unemployment rate correlated again on a downward sloping point. If we trace a downward sloping trend of data points, we can see a short run Phillips curve that exhibits the inverse trade-off between higher unemployment and lower inflation rates, like this. If we trace a vertical line of data points, we can see a long run Phillips curve kind of at so if you're kind of looking at this vertical line here, you can see that it kind of centers here around 3 to 4% as a natural rate of unemployment here. And you've got a couple over, a couple under, but it tends to kind of sit right in this range. So the argument for the United States is that you've got kind of a natural rate of unemployment at about 4%, and that should result in inflation somewhere in a 3% range. And and again, that should be our target. What you're seeing right now is, the Federal Reserve is saying we're targeting 2% inflation rate, which would probably give us closer to 5% unemployment if this Phillips curve, if a regression on this set of data held. So balancing Keynesian and neoclassical models. It may seem like, Keynesian economics, neoclassical economics don't, they're converse to each other, and they don't connect. And so as a result, it's one or the other. And really, most mainstream economists believe that both the Keynesian and neoclassical perspectives have value and are useful for policymaking decisions. So at short time scales and sometimes really big recessions and depressions like that which occurred in 2008, 2009, that which occurred potentially during COVID, as well as a Great Depression. The Keynesian model can be a good approximation of how the economy works because there is a obvious demand shock. However, at longer time scales, that neoclassical framework makes the most sense because, again, you're trying to drive up additional productivity in a system, and that's really how you're going to see long-term sustainable growth. So you'll hear, I tend to, in a personal role, and kind of when I've been in positions, when I've had positions where I've had to make some of those kind of decisions, or where I've advised policymakers, I've tended to lean toward neoclassical decision making for the most part, because we need to have a longer term view of things rather than just what's in front of us. But having said that, the Keynesian model does work in the short run, and when you're experiencing significant pain, significant, families out of work, people starving, those kind of things, you need to be able to drive some of those things in the short run, even if in the long run it's going to be counterproductive and drive inflation. So you can balance these two things out. It's like anything else, it's normally not all one or all the other, but it's a mix of the two that will tend to get you to the best policy decision.